Given the backdrop of recently proposed amendments to the finance bill, from April 2023 onwards, capital gains arising from debt-oriented mutual fund schemes will be treated as short-term capital gains, irrespective of the period of holding. Now, investment in hybrid funds has emerged as a suitable option. But before we get into that, Feroze, let's discuss the category and its suitability for investors. Could you please elaborate on the types of hybrid funds we are talking about here?
Yes, hi Kavita. Like you rightly said, it's very contemporary to look at hybrid funds today, especially after the amendment to the finance bill, which got passed as well. Because hybrid funds mix both equity and debt. And if you look at the hybrid funds, more importantly, there is conservative, aggressive, dynamic asset allocation, arbitrage, and multi-asset allocation funds. There are 5 types of hybrids if you have to classify them. The aggressive ones, of course, as the name suggests, have a larger portion in equity. The conservative ones have a larger portion in debt. Dynamic, as the name suggests, are quite fluid in terms of their allocation, and they don't stay static between their equity and debt, and so on and so forth. So arbitrage funds are very debt-like in terms of behavior. But in taxation, they are equity-like. So I'll stop here, Kavita. You can give me some pointed questions and I can answer them for you.
We have so many categories within hybrid funds. Equity savings is a neglected category. You can elaborate more on that because this category among hybrid schemes has the lowest AUM of almost 16,445 crores. But that could change soon. Do you think that for retail investors, are we looking at BAFs or equity savings which can come handy for them?
Yes, Kavita, you're absolutely right. In terms of the assets, equity savings as a category is very small. But after the change of Section 50AA, which is the new section which was introduced on the budget day, but got amended before the bill got passed, and debt funds were roped in other than MLDs, actually tells you that if there is more than 35%, anything little more than 35% in equity, then the taxation of long-term capital gains will be applicable, and you will also get indexation. So investors will look for schemes which have just about 1/3 of the money in equity, and equity savings category generally has 30 to 40% invested in equity. So I think this will start getting traction, momentum, and there's going to be a lot of investor interest because most investors actually have equity of 35% and debt of 65%. Which investor does not have 35% in equity? Most retail investors and even HNIs at least have 35%. So a combination of both these, which is what will give tax efficiency to the debt side, will definitely find some degree of tailwind. And I think this category will definitely see a push.
I would like to take you back in time, maybe to early 2000, where fixed deposits were compared with income funds, or, there were always a versus debate going on between these two categories. Do you think that's a time now?
See, I think you're right. Of course, the tax efficiency of debt funds, pure debt funds, especially the target maturity funds, which I personally think have been the reason why this change of taxation got triggered, because as per Section 48 of income tax, bonds and debentures should not get indexation. But a target maturity fund, which is nothing but 1 or 2 bonds put inside a box, they were getting indexation, which was a little loophole kind of scenario, which is why target maturity funds going forward become lesser attractive. So coming back to your question, Kavita, will there be a debate? The answer is yes, because FD's tax efficiency has suddenly become not so much of a problem, because target maturity funds will also come as short-term capital gain. But hand on heart, I think still debt funds and target maturity funds will win hands down, because capital gain as a head of income is one of the most attractive heads of income, because FDs give you interest income, and debt funds, even if they give you short-term capital gain is a very attractive head, and several set-offs are possible as per Section 73.
Feroze, I would also like to explore arbitrage fund within this category. Now, talking about pure debt allocation, do you think a move on the arbitrage fund will be seen over here? How do they work?
Yes, Kavita, I think arbitrage fund, because they buy equity, and they also hedge the equity which they buy by shorting in the futures market. So from a return profile, it is more debt-like. From a taxation profile, because the underlying is equity, You're buying equity in the cash market. You're selling the same commodity in the futures market. So risks are cancelled. The difference in the price between the two markets, which is what is the arbitrage opportunity, is what arbitrage funds capitalize on. For example, if Nifty today is at 17,400, May Nifty will be at 17,500. So buying Nifty of today and selling the Nifty of 25th May, which is the last Thursday of May, the 100 rupee differential is called the arbitrage opportunity. So to answer your pointed question, Kavita, arbitrage funds are going to be very much in favor because they give equity taxation, not just debt taxation of the old regime, but even more favorable. And the short-term capital gains tax is only 15%, and long-term capital gains after 1 year is just 10%. So I think arbitrage fund is going to have a large flight of capital from the other debt categories, which from 1st of April have become lesser efficient from the taxation standpoint.
Feroze, do you agree with this, that earlier so much of thrust was not given to hybrid category, among the debt investor category? Why was this neglected or sort of, not thrust upon?
See, Kavita, mathematically, if you forget taxation, it's always good for an investor to do asset allocation at the portfolio level, not at product level. See, what happens is if a person has, let's assume, 10 lakh rupees, he is going to decide how much will go into equity, how much will go into debt on his overall 10 lakhs, and then allocate debt separately, equity separately. This has one advantage, that you are in the driver's seat when it comes to asset allocation. That's one advantage of doing that. Second, that your debt is going to be cost efficient, because if you're investing in debt, you should not spend so much money on fund managers, because in debt you can't do too much. In equity, you can spend good quality money to get the best fund management. So two advantages of doing asset allocation at your level is why hybrid funds were not in favor. Now that there is a tax advantage to make hybrid funds more attractive than pure debt funds, I think people have to relook at the advantages and measure the pros and cons and make their calls. If somebody's got just 2,000 rupees to invest in a month, then I think a hybrid fund was always a great option. But if somebody's collected a reasonable lump sum amount, I think keeping equity and debt separately always is a better strategy than mixing them up.
How can debt funds be stressed by AMCs? Now, AMCs have gone in overdrive on debt funds. You think the stress will be on outperformance over fixed deposit and product features now?
Yes, Kavita. See, basically every financial institution is fighting for the same pie, which is the household saving, which as per one of the CRISIL report is 3 crores in India. So of course, debt funds are going to have more pressure to deliver better performance than fixed deposits on a post-tax basis. But I think debt funds will also bring in some degree of tax efficiency. Even the conventional debt funds will have some degree of arbitrage, to my mind, or some degree of equity. I think the asset management company will also push equity savings schemes like you in the earlier part highlighted, Kavita. I think there will be a lot of innovative caps put. And I think as we speak, AMCs are thinking of how to bring back debt funds into post-tax efficiency so that they can compete with the FDs and have their market share as well.
Currently, looking at the longer tenure bond, do you think these are favorable for investors to invest in right now?
See, longer term bonds, Kavita, yes, I think so. We are in the interest rate cycle, which to my mind has peaked out long back. I've been saying this for the last 7-8 months. The 10-year GSEC has not moved up at all. So repo might have moved up from May 24th last year by 2.5%. But 10-year GSEC is exactly where it was on 24th May last year. So I think we are at the peak of the rate cycle. So if you're going to lock in yourself a 7.3, 7.4, even on a Government of India bond for the next 10 years, it is very lucrative. If you go to state development loans, you're getting 7.6, 7.7. But I think corporate bonds of long terms are not worth today because the remuneration these corporate bonds are giving is very little. If I'm going to get 8 with a AAA rated corporate and 7.4 with Government of India, I will always choose 7.4 because in 10 years, corporates can go through whatever they have to go through. Why will I take that risk for just a 0.6% more? So to answer your pointed question, Kavita, government bonds, state development loans, lock in for long periods of time, great idea. Corporate spreads are so thin that it's not attractive or even worth your time for that 0.5%.